world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here.
Hello and welcome to Rebank. I'm your host, Will Beeson. Today we have a fascinating episode with two London-based venture capitalists. Aman Guy of Orange Growth Capital has been investing in fintech and other technology companies, first at Excel Partners earlier in his career, and now at Orange Growth Capital. In between, he spent some time at Facebook and other technology companies. We're also joined by Alvaro Alvarez del Rio, principal at Initial Capital, a mobile games and fintech-focused venture capital fund. Alvaro is also a director of Swordfish Investments, where he's been since 2011. Both Aman and Alvaro have deep expertise across technology and are now applying that to fintech. If you enjoyed today's episode, reach out. Connect with us on Twitter at Rebank Podcast or with me, your host, at Will_Beeson. You can find us on Facebook, LinkedIn, or at our website, www.bankingthefuture.com. Thank you very much for joining us today. Please welcome Aman Guy and Alvaro Alvarez del Rio. Aman and Alvaro, welcome to Rebank.
Nice to be here.
Thank you. Maybe we can start with a quick bit of context. Alvaro, what's your background and what do you do at Initial Capital?
Sure. So my background is actually in finance. I started out in investment banking for a few years, worked at two of the large banks here in London, did a bit of private equity, worked at a family office, and eventually closed the circle with venture capital investments. At Initial Capital, we invest at seed stage in mostly consumer mobile companies.
Aman, same question. Can you tell us quickly about your background and what you do at Orange Growth Capital?
Yeah, so I also started off in investment banking at Credit Suisse, both in San Francisco and here in London. I then moved to Excel Partners, which is a pretty big venture capital firm. Found my way into Facebook, where I spent a lot of time looking at their mobile platform partnerships business, and then ran a gaming studio for a European game developer. And now at Orange Growth Capital, I spend a lot of time looking at Series A companies, early stage companies, mostly focused in the financial services and software space.
So you guys both come from, I suppose in Alvaro's case, more of an investments background, and in Aman's case, more recently, a tech background. And you bring that experience to your investment work now. I'm interested in how that perspective, or I should say those perspectives, shape your approach to fintech. Because neither of you, from the sound of it, come from a retail banking, a commercial banking, a lending background. Aman, how do you define fintech, and what do you see as driving it?
Yeah, it's an interesting question. I guess the way I think about fintech is in two buckets. The first bucket is software companies, in particular, that help existing incumbent financial services companies, so it could be banks, insurance companies, wealth managers, either make more money or save money. And the other bucket is companies that disintermediate existing, let's call it brokers, offline brokers. So companies that build marketplaces that have an effect on real estate, automotive, and a number of different other verticals with financial touch points. So those are the two buckets that I would generally call fintech for us.
Mm-hmm. So two categories of companies, it sounds like. One that design propositions that help incumbents either increase revenues or reduce costs. And one that kind of I don't want to call it fringe, but that play at the edges of either elements of delivery or customer experience around maybe less regulated, less capital intensive, less infrastructure heavy financial services.
Yeah, that's a good point. You raised a few key words in terms of capital intensive and customer experience. So, for instance, we haven't made an investment in a neobank or challenger bank, not because we think those are bad businesses, but primarily because we think those aren't venture businesses. They require a lot of capital and something different from what our mandate requires us to do. But on the other hand, we invest in companies that let's say improve user experiences. So a company that we invested in, for instance, called Trussell, in the online mortgage broking space, helps consumers easily shop for a mortgage, as opposed to going to different banks, 90 different banks, to try and find the best rate for themselves. They can do that all sitting at their house in front of the computer. So that's how we look at the two worlds.
I think that's a very good point and an important distinction, and one that's maybe lost on people that don't necessarily come from the investments community. That distinction between which types of companies are best suited as investments for which types of investors. I think, broadly speaking, popular culture is familiar with kind of the Silicon Valley model. So you're talking about looking for hockey stick growth, largely relatively capital light, maybe pushing for distribution, pushing for volume, infinitely scalable. And that can be backed by very large, quote unquote, venture funds, but which often are investing 8 figures in startups, which is very different than I think the vast majority of venture capital firms, especially in Europe. So thinking about what makes a suitable venture backable startup, and in Europe, it's probably playing on the fringes of fintech to an extent. It's not pursuing a banking license, needing to capitalize in line with Basel requirements, looking to raise large amounts of debt funding to drive loan origination, but look to automate, look to enhance efficiency, and look to potentially scale to both B2B or B2C propositions.
Yeah, exactly. I think if you look at how consumers are served with financial services, the neobanks come with the approach that consumers don't want to go into branches anymore. And I think that's a great proposition to have. I think it's extending that to different verticals of financial services that is pretty interesting for us. So I think we've seen that first wave of disruption in companies such as Money Supermarket, maybe helping you get a credit card or insurance online. And now we're seeing a further wave in many other verticals. So whether it's real estate, automotive, a car buying experience, whether it's how to manage your cash as another example, or fix a repair on your car without having to go to an insurance provider. So many different verticals that exist in the financial services space that can lend to better consumer experiences is something that we spend time looking at.
Alvaro, how do you think about fintech? What are the most interesting trends you're seeing play out in the space?
Yeah, I think that a lot of what fintech is about has been included in the discussion already. Effectively, the way I look at it is a very interesting group of companies that are playing at the crossroads of the two spaces where I've spent my professional career, be it finance and technology. And in a place like London, where the ecosystem is so important and there are a number of players in different parts of the ecosystem that are supporting that growth. From my perspective, obviously coming from a more consumer-focused background, I look at the second type of company that Aman was referring to, where disruption comes from the user experience perspective and the demands of a new generation of consumers that are simply not used to dealing with their finances and interacting with the financial institutions the way that previous generations did.
I think, admittedly, when we first connected and you described your fund's mandate as mobile gaming and fintech it wasn't immediately clear to me what the overlap is, but very quickly, the more I thought about it, it becomes strikingly obvious. It's all about user experience, and interestingly, I suppose we in fintech, like we in banking, are probably a bit kind of behind the times compared to people in broader technology. But you hear people in banks talking about gamification and how that's going to improve the customer experience. Obviously, mobile gaming is all about gamification, and therefore the overlap is pretty apparent. Alvaro, maybe you can go first. Can you guys talk about some of the fintech investments you've made?
Sure. Interestingly, as you might expect, most of them are at the crossroads of gamification or gaming services and financial services, and they are mostly consumer focused. So a couple of companies we've invested in, there's a company called Bucks, which is based in Amsterdam, with a management team that comes from a traditional stock trading platform, online platform, that has set out to disrupt the market of stock trading by gamifying the whole experience and targeting a new type of demographic that has never traded and is not used to sitting in front of a screen with a number of charts and figures and just making a decision based on that. So there's a high degree of education that goes into into what Bucks is doing, and a good amount of content that they're publishing in order to educate their audience. But the results are very promising in that around 80% of the user base that they've got have never traded before. And when you sit down and speak to the users that actually spend a ton of time on the platform and trade most often, the realization is that most of those users are between 18 and 25-year-olds, when most of us, when we were 18 years old, were not even thinking about trading, potentially because we were not given the opportunity to get access to a world like online stock trading through a platform that was intuitive, that was easy to understand, and that took us step by step into the world of trading. And funnily enough, that's an investment that we share with Orange Growth Capital. The second one that I want to mention is a London-based company called Divido, and what they do is again, they're B2B to C type of proposition where they're going after the long tail of the installment market, both online and offline, facilitating the relationship between online retailers or offline retailers with the financial institutions in order to provide easy payments in installments to people shopping at retailers. Now, the beauty of tools like this is that they're almost invisible to the consumer. You just go to the shop, you purchase your items, they're high value items. At the point of sale, at the till, you are offered the opportunity to separate your purchase into installments, and it's as easy as that. And within 5 seconds, you get an answer, and you can leave the store with your purchase easily done in installments, and it can heavily influence your purchase decision as well. So that's, in my mind, that's the beauty of the consumer-focused experience in fintech. It's that tools that are very powerful and that have the ability to change behavior patterns in the consumer are almost invisible to the eye of the consumer.
Aman, what about you guys? Any noteworthy fintech investments?
Yeah, well, apart from the company we share with Alvaro, Bucks, one of the companies we invested in here in London is called Trussell, as I mentioned before. They are trying to disrupt the traditional mortgage broking space. So Trussell is essentially connecting you to over 90 lenders instantly. Their thesis is around, look, if I want to get a mortgage and if I want to shop in a branch or someone's website, I would generally go to maybe 2-3 banks and get a sense of pricing. For them, it's about giving you that wide array of options, what your risk profile is. Do you prefer a 2-year fixed or a 5-year fixed? When would your repayments come up? And more importantly, I think in the mortgage market, what's interesting is people don't realize how simple it is to actually remortgage your house. So they're focusing on those two elements of of getting you new mortgages quickly, as well as helping you remortgage your house and save money more quickly. On the more, let's say, core infrastructure side of things, we've invested in a company called SafeNet, which basically helps private wealth managers across different institutions optimize where their clients' wealth should lie. Should it lie in a euro-denominated account in Poland, or should it lie in a euro-denominated account in Germany, and help them arbitrage and get the best interest rates for their clients, particularly given that we live in a low interest rate environment. So we generally look at a fairly broad spectrum, consumer focused, just like Apple does, and on investments like Bucks, as well as more enterprise driven investments.
How has your, maybe start with you, Aman, how has your experience, for instance, you mentioned having worked at Facebook previously, has any, call it broader tech experience informed your decision making around fintech, informed the way you think about fintech propositions? Are there particular learnings that have been relevant?
Yeah, it's a good question. I get asked quite a lot, actually. Has working in an ops environment changed the way you view not only fintech, but investments in general? If you asked me this question before I joined Facebook, my answer would probably have been yes, I think it would. But I think in hindsight, every investor brings something different to the table. And the venture business is a lot about pattern recognition. So the longer you are in the venture business, the better investor you are in general. You see more companies, you make better decisions, you make mistakes, just like everyone else does. And so, yes, it's helped me to a certain degree in terms of maybe having a certain level of empathy with an entrepreneur that has seen ups and downs. Has it made me a better investor? I hope so. Is it absolutely crucial to have? I don't think so.
What about you, Alvaro? Your kind of tech experience, your games experience specifically, has that informed the way you look at fintech or the way that you make investment decisions around fintechs?
Yes, absolutely. I think that any consumer business, and particularly consumer mobile businesses, have learned a lot from games companies in the past few years. And those learnings include things like how to take a data-driven approach to your metrics, how to optimize your funnel from the moment someone views an ad to the moment they download your app, and how they engage with the app to the moment they actually make a purchase, which is extremely relevant, obviously, to all consumer businesses. And the analysis of those metrics, which is something that has been happening in the space of mobile games for a very long time, is a pattern that has been adopted by consumer businesses in the last few years. And from what I can see, every successful company in the consumer mobile space nowadays is running a very data-driven company, where their approach borrows from that experience that to some extent the games business pioneered.
Are there any specific technologies or macro trends that you guys expect to shape the next few years of startup investing?
In fintech in particular?
Not necessarily in fintech, more broadly.
Yeah, I think given the environment we live in, where I think capital is fairly widely available, I feel investors have got a lot smarter about deploying that capital. So I believe in the next 1 to 3 years, you will see a very strong focus on unit economics of that business. On the consumer side, it's being gross margin positive. I think it would be a hard proposition to sell a Series A investor or even a seed investor if you're not able to get to that point pretty quickly. I think we've lived in a world in the last 12 to 18 months where there has been a promise of that, but has not maybe come into fruition. On the software side, I think companies will now get a better sense of how to actually build a sales team. I think that is super important. In fintech in particular, selling to banks or financial services companies is probably the hardest thing in the world. That said, I think what's really exciting about it is financial services companies spend over 700 billion a year on software. But you need to have the right infrastructure in space internally to be able to service that. So having a VP of sales that is strong at getting you pilots at banks, having a strong customer success team that understands what your customer wants, so you can go back to that customer after a year and upsell another service is super important. And at the core, a very strong engineering team that banks can get comfortable with, so they can onboard you quickly as a vendor. So I think we will, over the next couple of years, go through a period where these startups have to grow up and think about how to actually build a company as opposed to just executing on their vision.
I think you've got two types of trends that you can analyze. The financial trends, as Aman described, for the most part, I expect the next few years to continue this trend of widely available money into the ecosystem. And that gives me a lot of hope for an increased pace of technological progress. Then when you look at it from the technology standpoint, I think that there are very high-level themes that are defining the progress in technology, including automation, the level of redundancy in the different processes. We were talking about how some of our companies are disrupting certain sectors through automation. Things like artificial intelligence becoming sort of an overarching theme in all technology-related investments, and just one more layer of investment rather than a specific vertical. And I think the combination of that availability of capital and those promising technology trends are setting us up for a very interesting couple of years.
What distinguishes each of your funds, be it around expertise, decision making, or investment views?
Yeah, I can speak for our fund in particular to give you a sense. We're about a 100 million euro fund.
So this is Orange Growth Capital for the
This
listeners.
is Orange Growth Capital, yes. We're a fairly small team. We scour over Europe to try and find the best opportunities for us. And the way we like to think about ourselves is we have the right expertise in the financial services space, be it from people who've worked at different touch points. So we have folks who've worked in the insurance business, in the banking business, in the marketing business, in the consumer-facing business. And these are the elements that basically go into serving or disintermediating financial services. So we hope we can kind of bring that expertise on board to a startup. Now, we're minority investors, so we never get involved in day-to-day running of the company. We invest in the entrepreneurs themselves to run the company, and we always want to be behind them and support them where they need, but also open doors where they need to be open. So getting into a bank is an extremely hard proposition. They're doing a better job now. They have innovation departments that can get you on board to try a paid proof of concept pretty quickly. But I think the struggle we're seeing is how quickly these companies can go on to becoming an official vendor of a bank, which is really where you start tapping into the spend of the bank. And hopefully we see ourselves as opening the right doors for these startups.
Yeah, at Initial Capital, I think there are a few things that set us apart. The first one is that we are pretty focused in terms of the sectors that we invest in. And so that gives us a very deep knowledge of those sectors. The second one, which is related to that, is that half of our team comes from an operational background and half of the team comes from a more corporate or financial background. And so that amplifies the the amount of viewpoints that we have at our investment committee when we make decisions. And then another one that is, I believe, quite important is that our fund is internal, so we run our own capital. And I think that when it comes to putting yourself in the shoes of the founders, when it comes to the founders identifying themselves with the culture of the fund and with the values behind the fund, it's important that you show them that you have skin in the game and that you are trying to maximize the value, because it's equally important for you to make a success out of the company as much as it is for the founders to make sure that the company is successful.
Aman, I think you made a great point before about maturity, thinking about fintech companies which initially were looking to kind of pick off juicy parts of banking and financial services. And certainly companies are still looking to do that. I think by and large, we haven't seen the scalability, the traction of some of those propositions in the way that kind of early on we thought we would. And we're seeing an increased focus on fintech servicing banks, B2B propositions, effectively competing more with software vendors than with banks themselves to a large extent. And I think in terms of maturity, we're starting to see companies with a bit more gray hair on management teams, people who have experience working in banking and financial services and who are starting to build some of the infrastructure, the organizational robustness in terms of risk function, governance function in order to become a trusted supplier to banks. Thinking forward, how important do you expect startup incumbent partnerships to be in fintech? And I guess to what extent do you expect this focus on competing with software vendors as opposed to competing with banks themselves to continue?
I think the number I threw out was $700 billion on software spent by financial services. That's a really easy number to get sucked into, not only as an investor but as a founder, in terms of thinking, okay, this is a large pie that I can go after. But that pie gets cut in so many different ways. And each slice has its own different, unique selling point, strategy that you need to focus on as a financial services entrepreneur. And I think that's what maybe the startups need to think about before they decide to focus on a particular sector, is how can I best serve the financial services incumbent that I'm trying to sell to. I think it's very easy to, as an investor, want a Dropbox-like solution for a software company that is trying to sell into financial services. Unfortunately, I think that's a very hard thing to achieve. Banks require a certain level of service level implementation, which means there will be a professional services component to that. I think as financial services investors, we're pretty comfortable with that element. But I would encourage startups to think more about how they can, for instance, build a channel partner network, how important it is for partners to actually do that implementation work, and how much money the partners themselves can make by using your core software as a tool when they speak to banks. I think that will help speed up a lot of the implementation work they do. For instance, one of the software companies in the financial services space that is not talked about that much is called Guidewire. It's a core system for insurance companies. The company makes over $500 million in revenue every year, grows 50% over a year, but has a large services component to it. At the same time, they figured out how to build a great channel partner network program. And I think for startups, as they think about what are the right opportunities for them to focus on, I would say instead of trying to, let's say, tie up with a bank, try and focus on building this services ecosystem around your product.
And that might be, for clarity, something like working with a Deloitte, a PwC, people that are helping banks, financial service incumbents design propositions and then are assisting with the implementation as well?
Exactly. And remember, this is all about unit economics. It has to be profitable for them as well to do the implementation. And at the same time, you need to give them the tools to make their life simpler. So when they get into a bank, the bank is pretty happy with the service level that they provide. So I would encourage startups not to be sucked into trying to build, let's say, the next Dropbox for financial institutions where it's a plug and play solution. Because I think those things are very hard to do given the infrastructure environment that banks or other financial services operate in.
I think that's phenomenal advice. How do you guys expect banking and financial services to evolve in the next few years? Alvaro, maybe you want to start.
Yeah, I think that a trend that has already been shaping the world of fintech in the last few years and will continue is that a lot of the innovation comes from within, actually. And a lot of the people that are working at banks are best placed to understand where the friction points, where the pain points are. And a lot of those people are leaving the industry for different reasons and setting up the fintech companies that are disrupting the sector. So I think that what we'll see is increased innovation in the sector. There has been increased innovation in the sector for a few years, and I only expect that to accelerate. I think what we'll see as well is that, as Aman mentioned, there will be an increased level of partnership between the incumbent institutions, the financial institutions, and the new, more disruptive institutions that in some instances can actually work to provide those services that are not being efficiently provided by the incumbents. And I don't foresee what I've heard other people say, that challenger banks will kill the traditional bank. I think there is a number of purposes that traditional institutions can serve, and I think that they are here to stay. And what I think is that through that disruption, some of those services will predominantly move from incumbents to new players, but some of the services will benefit from that partnership between those mostly software providers that will partner with the banks and the larger institutions that still have very powerful distribution networks.
Aman, what do you think?
Yeah, I agree with Alvaro. I think in terms of themes, there have been a couple of things that have been thrown around over the last couple of years, blockchain being one of them. I think personally, blockchain has a long way to go. I think whether blockchain exists in its intended form for trade finance, supply chain, settlement, who knows? But I think we're living in a world for blockchain where each ecosystem wants to control the application built on top of that. And funnily enough, generally when there's a lot of noise in the ecosystem, no one actually wins. So as maybe the focus shifts away from building blockchain applications, you might find a few winners emerge, because maybe the banks realize, hey, it is not our core competency to build blockchain applications. And that's where I feel startups can then start to come in and really service financial institutions. I think artificial intelligence is obviously a word that's thrown out quite a lot, but I think it's very important to understand what the true meaning is. There's machine learning, which is probably the most prevalent in terms of the technology branch of artificial intelligence, and has been prevalent for a while. I think Alvaro probably knows in the gaming space, artificial intelligence has existed for years. I think we're starting to see business applications as a result of this. I think the other branch of artificial intelligence, which is probably more complex to solve and requires a lot more processing power, deep neural nets, is still a long way away from being, let's call it, commercialized in pure business application standpoints. So it'll be interesting to see how that evolves. I don't have a magic crystal ball. I wish I did. But I think coming down to what the theme is, finding ways by which banks can reduce their costs or increase their revenue is a general theme that we see across most of the startups that we meet.
Before we wrap up, I'd be curious to get views from you guys. Venture capital funds are kind of perfectly poised to support certain types of businesses at certain stages of their life cycles. Banks are doing some work, corporate venture capital, ARM, strategic and investment funds, to source the technologies that will support their own businesses, but also to kind of put a few bets down in hopes that they're involved if things take off over time. In your opinions, what's the best way for banks to invest in fintech? Is it arm's length? Is it invite startups in-house in innovation labs to do pilots? Is it to seed their own startups looking to meet specific business goals? What do you think the ideal strategy is for banks?
So I think banks are no different to any other incumbents from that perspective in any other industry sectors. And I think that one trend that has been predominant in venture capital investing for a long time is to consider that strategic investors are bad, that incumbents in their sectors are dump money simply because they haven't progressed in terms of their level of innovation at the same pace as the disruptors in that business are doing it. But the reality is that if you were a startup founder and I were to tell you, if you are in the fintech space, who do you prefer to have as a partner? The best venture capitalist in the world or a bank? Now, there are a number of reasons why you might be less than keen to tie up with a bank at an early stage, but the reality is that you should not forget that that person in that bank or the management team in that bank has been going after the same sector you're going after for many years. They have a number of resources at their disposal that they can help you with, and more importantly, they are the best platform where you can test whether what you're doing works or not. So in an ideal environment, which doesn't very often happen, I would see both the disruptors and the incumbents in any industry, and in fintech in particular, cooperating in order to bring that disruption from within. That's not to say that all the innovation labs and all the arm's length investments are not working. It's just to say that in an ideal world, I would hope to see my early stage fintech companies benefit from the help that they can get from the larger institutions in the market they're going after.
Anything to add, Aman?
Yeah, Alvaro raised a good point. I have first-hand experience in this. We often get confused with Orange, the telecom company, which we're not really affiliated to. But I can tell you, the way we think about kind of incumbents getting involved in this space is there's a right time for it. I think if you look at a lot of the insurance technology startups that are coming up, they often need a reinsurer to underwrite a lot of the distribution that they're doing, in which case it makes perfect sense for them to have a reinsurer back them, either from a partnership standpoint or from an investment standpoint. On the other hand, there might be certain industries where the investor would generally, or the company in general, would benefit from wider focus. So the problems that HSBC face, while maybe on a superficial level similar to what Barclays faces, but in a more entrenched level, very different. So I think it's important for startups to be talking to the right people, but at the right time.
Aman, what's the best way for people to connect with you and find out more about your work?
Sure. You can find me on Twitter at Mankai, it's a hard name, or you can email me at aman@ogc-partners.com.
Alvaro, what about you?
Well, you can find me on email. I'm at alvaro@initialcapital.com, or you can visit us on initialcapital.com, and there's just a way to get in touch with the team directly from our website as well.
Great. Well, Aman, Guy, and Alvaro Alvarez del Rio, thank you very much for joining us today.
Thank you.
Thanks for tuning into Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.